It's me, Harry Stebbings, and you are listening to the 20-Minute VC. Now, I would really love to have you more involved in the shows and hear your thoughts on great potential guests to have on, questions you'd like to hear me ask, and the best way to do that is to connect on Instagram at hstebbings1996 with 2 Bs. I'd love to see you there. But to the show today, and last month I promised we would have one crypto-focused episode every month, and today I'm thrilled to be joined by one of the most exciting players in the space, and a really very special person to me who's done so much and been so kind to me. So without further ado, I'm thrilled to welcome Avichal, Managing Director at Electric Capital, one of the leading crypto asset management firms today, investing in both liquid and illiquid tokens that are emerging stores of value and rooted in novel technology. Prior to Electric, Avichal and his partner personally invested in Coinbase, Bitwise, Basecoin, and more. And as for Avichal, as well as Electric, he's a part-time partner at YC, and prior to YC, he was a director of product management at Facebook, where he led the local product team, a $3.5 billion line of business at the time. Before Facebook, Avichal worked on search and ads at Google, started and sold a few companies, and invested in startups including Optimizely, Boom, Color, Cruise, Instawork, Case Text, and many more incredible businesses. And I'd also have to say a huge thank you to the wonderful Elad Gil for the intro to Avichal today. I really do so appreciate that, Elad. But before we meet today's guest, are you told your standards are too high? Well, the League is the app that tells you to keep them that way. They know your time is valuable, so simply tell them your preferences, and they will handle the scouting and vetting for you. Plus, even better, your profile will only be seen by people who match your preferences. Matches expire after 21 days, and so there are no drawn-out games. And they even require LinkedIn to protect your privacy and block you from matching with co-workers and business connections. I have to say, I am a big fan, and you can apply now by downloading The League on the App Store or heading to theleague.com. And speaking of products that I'm a fan of, you must check out Zoom, the fastest-growing video and web conferencing service, providing one consistent enterprise experience that allows you to engage in a variety of activities, including video meetings and webinars, collaboration-enabled conference rooms, and persistent chat all in one platform. Plus, it's the easiest solution to manage, scale, and use, and has the most straightforward, affordable pricing. But you don't have to take my word for it. Zoom is the top-rated conferencing app across various user review sites, including G2 Crowd and TrustRadius, and you can see for yourself. Sign up for a free account, not a trial. Just visit zoom.us. And speaking of connecting people there, you must check out Culture Amp, the platform that makes it easy to collect, understand, and act on employee feedback. From onboarding surveys to company-wide engagement, individual effectiveness, and more, the platform manages multiple sources of feedback and connects the dots for you. And that's why companies like Slack, Nike, Oracle, and Lyft all trust Culture Amp, and it enables leaders to make better decisions, demonstrate impact, and turn your company culture into a competitive edge. So put your people and culture first and find out more now on cultureamp.com. But now, without further ado, I'm so excited to hand over to Avichal, Managing Director at Electric Capital.
3, 2, 1, 0.
You have now arrived at your destination.
Avichal, such a pleasure to have you on the show today. I've been so excited for this one, having heard so many great things from Elad Gil. So thank you so much for joining me today.
Oh, my pleasure.
Well, I would love to kick off, though, with a little about you and really where the love of all things crypto assets came from and why you decided to start Electric today.
So I've spent most of my career as an entrepreneur and an angel investor. So I've been fortunate enough to work at Google and Facebook, started and sold 2 companies. I've invested in over 50 startups at this point. I'm an expert at Y Combinator. So I'm always spending time trying to figure out what people on the fringes of society and the fringes of technology are doing with their time. So back in 2013, a friend recommended I read the Bitcoin white paper. And I sat down and I read it and I was just blown away. I thought the technical insights were brilliant. I thought the implications of it, if it worked, would have been world-changing. I mean, to be honest, I didn't think it would actually work out, but the idea of it was amazing. And really, I was just blown away by the elegance of it. I mean, I still, to this day, if I go back and read it, it's just remarkable to me that a human being came up with that, or human beings came up with it. It's just so crisp and it's so thoughtful. So I thought it was brilliant, and that sort of sparked an interest. And then I was at Facebook at the time and tracked the space as a hobbyist for a few years. And then after I left, I decided to think about what I was going to do next and was exploring a couple of different areas and started going to conferences again and reading more white papers and going deeper and deeper. And then the market kind of went crazy at the middle of last year. And as it was going crazy, a lot of people were inbounding saying, hey, you've been thinking about the tech here for a long time. You actually understand it. Can you help me do diligence on this thing or that thing? And then that slowly turned into, hey, I don't have time to due diligence. Can you just tell me what to buy? And then that turned into, oh my God, I have to do what to buy all this stuff? I have to jump through how many hoops, and how am I going to do custody and, all these things? And so they said, can I just give you money to do this? And so my co-founder from my previous startup and I were already spending all of our time doing this just out of interest and out of fun, and had been for a year. And so we said, hey, if people want to give us money to do this, we should consider actually just turning this into a business. And so we decided to start a firm around it, in part because of that opportunity, but also because I think what's happening is that cryptocurrencies are this massive platform shift in the world. They represent a change in a lot of different dimensions, and everything from how we build companies to business models to, I think this is software eating money. And so there's massive markets that are going to be consumed by software yet again, and so on. And so I think if you look back at the history of technology, this happens every 10 to 15 years or so, one of these massive platform shifts. And in every one of those eras, you can get new financial firms, you get new investment firms, you get new early stage companies, you get new angel investors. And so I think this represents one of these big platform shifts. And so when I was thinking about where I could spend my time and actually be the most helpful and have the most impact, there was the option of starting a company again. And I have a great co-founder, and we explored that option. And the other option was to get a firm off the ground and help a number of companies. And we decided to go down that path because we realized that a lot of what we were good at and where we could add value would be in helping other people get their companies off the ground and add value across a lot of companies, because we've now done it a few times and sold, between the two of us, we've started and sold 4 companies. And so we decided that would actually be the highest impact thing for us to do for the next several years. And so we decided to start a firm.
I mean, 2 subsequent questions from that I can't not dive into. One I have to give Elad credit for, but you mentioned the 50 angel investments there. I'm intrigued, and so is Elad. How does tech investing in the angel perspective that you've done compare to crypto investing today?
Yeah, I think they're actually very similar. I think there's kind of at a high level 2 categories of crypto companies. There's the stuff that's already liquid, so there's the Bitcoins and Ethereums of the world. And then there are a number of early stage projects, and they may be liquid or they may be illiquid, but in practice, if you look at kind of where they are in their development cycle, they're very, very early. And I think crypto companies or protocols are going to have the same challenges that any other company has. I think you're going to have, everything from how do I hire my first product manager, to what does a great designer look like, to what is my go-to-market, what is my brand positioning. I have 15 people on my team now. How do I actually structure this team? I think a lot of the human problems are going to be the same. And so when we're thinking about which projects are interesting and why, we look at basically the same things that you would look at it in non-crypto companies. You look at the team, you look at the technology, you look at the market, you look at the traction. And so you evaluate them really on the same dimensions. Now, the way that you measure them is different, though. The way that you think about where the value will accrue might be different. The way you think about the business model might be different. But actually, the core of it is very similar in terms of looking at which companies might actually work, which teams will work, how those teams will scale, and so on.
You also mentioned the element there of kind of the hurdles that one has to jump through in order to really understand and invest in the space, custody just being one of them. We've seen this immense rise in dollars invested from traditional venture funds into the space. How do you think about traditional VCs entering the space in the hype cycle that we're in?
Overall, I think it's great. I mean, I think there's a lot of value to be created here. I think one of the things that's been fantastic in the last 6 to 12 months in particular has been the caliber of entrepreneur that's coming into the space. And many of them were hobbyists for some time. Many of them are brand new to the space, but you can just see the caliber of people coming into the space has really leveled up in the last 6 to 12 months. So overall, I think it's great. I think the challenge, of course, is that a lot of the nuances here are, which companies will ultimately succeed and why. And so if you look back at, let's say, Internet 1.0 in the early 90s, a lot of people understood, or even in the mid 90s, a lot of people understood that it was this information superhighway. And so now information would flow much more freely. What a lot of people did was they pattern matched that, and they said, well, of course, then the New York Times and CNN are going to be the big winners here. The information brokers of the day are going to be the big winners. In retrospect, obviously, that was wrong. The really big winners were companies like YouTube and Twitter and Facebook, the people that did things natively to the platform. So I think that's always the risk for the VCs or for the ecosystem in general, is that investors pursue things that pattern match to things that we already know, rather than identifying the places where the platform is natively able to do things that we weren't able to do before. And then those native companies, in this case, the crypto native companies, I think are going to be the ones that really accrue value and create value in the long term. And so the challenge ends up being, how do you identify those? And I think that's actually a big challenge for traditional VCs and existing ones. But what's great for the new ones is that we can start from scratch. We don't have any institutional processes. Our LP base is different. The way we think about how to pursue some of these things, we can kind of do from first principles and from a fresh perspective.
I mean, you're setting me up so nicely there with where the value will accrue, because I want to start by asking about where to invest. We've seen never before such dollars flowing into the space in the form of ICOs ICOs, but you said to me before that they're maybe going to the wrong place. So if we set the scene a little bit here, where are the majority of ICO dollars going today, Avichal?
It's a great question. And just, as context, this is a very risky asset class. Everybody should do their own research, and, this is not investment advice. But I'll share how I think about what's happening. And it goes back to this idea of, if you look back at the history of technology shifts and platforms, the first wave of things are sort of pattern matches of what worked on the previous era's platforms. And so today, if you look at crypto, there are 4 buckets of things happening, I think. There are things that look kind of like money. So this might be Bitcoin, Monero, Coda. There are smart contracting platforms, things like Ethereum or Thunder. The third bucket is distributed computation and infrastructure. And then the fourth bucket are distributed applications. And if you look at a lot of where the dollars are going, especially on the later stage private rounds or what used to be called ICOs, they're really going to those latter 2 buckets. They're going to distributed computation, infrastructure, and distributed applications. So computation, infra, and applications are where the dollars are going. What's interesting about crypto, though, is really in the first 2 buckets, in my opinion, because that's where we can now do things that we previously couldn't do. So rather than saying, hey, this thing works on the internet, let's decentralize it, I think the question people should really be asking is kind of the inverse of that, which is, hey, we have this technology. What can we do with this technology now that we just couldn't do before? And I think when you dig into that, you really end up with 3 things. One is digital store of value. I can move money into this digital asset and get it somewhere else, and often transfer it, cross-border in very efficient ways. And I think there's real novelty there and there's real utility there. The second is privacy. So I can now perform a transaction with a third party and nobody else can see the details of that transaction, nor can they see who was involved in that transaction. And I think if you think about things like healthcare payments, that seems pretty reasonable. I should be able to pay for a medical bill and no third party should know who I transacted with, whereas many of the blockchains today are public. And then the third is smart contracts. And that's essentially, I can give money to code and now code owns the money and the code decides what happens to the money. And that's pretty novel. And that starts to look a lot like wills and trusts and escrow and eventually potentially REITs and other securities and money-like instruments. But I think those are the places where there's real technical novelty, and that's where you'll get crypto-native companies emerge, even though most of the dollars today, I think, are going towards those last 2 buckets of distributed computation and distributed applications. I don't think that's actually where most of the really new value will get created in the long term.
Can I ask, you did say, though, to me before that fundamentally it doesn't make sense from an investment perspective, from an ROI case, in terms of the dApps and the distributed computation. Why is that?
Yeah, that's a really good point. So just to clarify that previous statement, that doesn't mean that there isn't great technical work happening in those last 2 buckets. As a technologist, I look at that and I say, wow, this is fantastic. There are a lot of very, very smart people working on these important problems, and over time that infrastructure will emerge, and it'll be really interesting to see what happens there. The challenge from an investment perspective or an ROI perspective is really the way that those things are priced. So if today those things are raising hundreds of millions of dollars, or in some cases billions of dollars, how do you actually expect those tokens to appreciate, or how do you expect to generate ROI on those? And it's, I think, extremely challenging. I think if you look back in every previous wave of technology, really the value that gets created for investors happens either from things where there are very predictable businesses going forward at large scale, and you're able to move a lot of money into those businesses, or it happens at the very, very early stage where the valuations of these companies are such that you can expect on a risk-adjusted basis to potentially make a return. And right now what you have at the late stage is a lot of money and a lot of risk. And so you haven't really de-risked it, but there's a lot of money going in. And so as an investor, you look at that and you say, wow, that's a pretty tough place to put money. That doesn't necessarily mean it won't work from a technology perspective. Just from a valuation perspective, some of these things are just really out of whack right now.
You also mentioned the element of store of value there. It's one which I honestly, I can't get my head around because of the volatility risk. So my thinking to you is, how do we embrace and kind of expect the volatility risk to pan out? And is the future then stable coins?
So I think there are going to be 3 things that really help with the volatility. So one is we have emerging derivatives markets, and the derivatives markets are going to create some structure around the volatility and will drive down the volatility over time. 2 is I think you're just going to have more capital coming in. So increasingly you're going to have people who are long hold, or as over time the deeper pools of capital decide to come in, I think that's going to create a stabilizing force in the market. And the third is you have increasingly professional traders coming in, and they're going to make the market much more efficient. And so I would expect that over time, over the next, say, 5 years, the volatility will go down in the space and it will start to look like a better and better store of value. It's also worth noting that store of value in some sense is relative to your alternative. So maybe relative to the US dollar, you look at it and you say that's not so great. But relative to a lot of other things, or relative to the government in another country, say a dictatorial country, being able to seize your assets, something that has some volatility, but is hard to take away from an oppressive regime, doesn't seem so bad as a store of value. And so, if you rewind through history, take something like 1930s Germany, it seems actually pretty great, even if you have a little bit of volatility, that if you had an asset that you could have protected from the government, I think that would have been considered a great store of value. So I think when you look at the volatility, these three things coming in with derivatives platforms, with deeper pools of liquidity over time, and with professional traders coming in to stabilize the market, I think will actually drive down the volatility considerably.
Well, I'm thrilled to be joined on the show today by a fellow historian. That's always a joy for me. I do have to ask one subsequent concern that I'd love you to quash of mine, and it's the element of liquidity, obviously the holy grail in the space. How do you think about liquidity, and kind of from both the kind of consumer investing standpoint, and then also now with external investors?
Yeah, it's a double-edged sword. I think on the positive side, the fact that many of these protocols or companies can go public, so to speak, onto these markets, onto the secondary markets in 2 or 3 or 4 years instead of 7 to 10 years from an investor's perspective is a huge advantage. On the flip side, you then have to think about how to manage that liquidity. And so what you really have, and part of why I think there's an opportunity for new firms, is you both have to do some of the early stage work, but then in 2 years, you also have to think about how to manage that public liquidity. And so a lot of what the firm has to get good at is both early stage and later stage sorts of thinking and processes, and how to use software to do all of that. And so it's a bit of a double-edged sword, because as an angel investor, for example, I can give money to a company at the seed stage, and then 10 years later, hopefully something great happens. And so I don't have to worry about managing it in the middle from a valuation perspective. And in this world, you actually have to be very thoughtful about how to manage that. And so if you have some investment and you're fortunate enough that it goes up by 10x or 20x, what do you do if you're 2 years in? Do you hold it all? Do you take some of it off the table? Do you just think it's in a bubble and take it all out? So I think managing the liquidity actually becomes quite a bit of a challenge, even though there are obviously some great aspects to being able to get liquidity in 2 or 3 years. On the retail side, I think it's really, really tough. I think unless this is basically a full-time job, it becomes kind of like day trading or speculating, which I think is very, very risky. And so hopefully people are not risking money that they can't afford to lose. And the liquidity traps in this world are very real. Everything from exchanges fabricating some of their exchange volume to there's a market correction, potentially liquidity drying up very quickly in some of the long tail coins. And so I think you have to be very, very careful. And so hopefully, retail investors are not trading on money that they can't afford to lose, because I think a lot of people could end up in that situation.
So now you've covered my concerns. I'd love to touch on a concern that I always hear posited in market, and it's kind of the impact and control imposed by regulation and government. But you've said to me before that it's the opposite of the real risk. So I love a contrarian thought. Why do you think that it's not a risk then? Let's start with that.
Yeah, so if you look at what does the government actually care about, I think the government cares about basically 3 things. One, they don't want retail investors to get defrauded. They want people to pay their taxes, and they don't want you to give money to terrorists. So those are pretty reasonable things, right? Each of those is actually very reasonable. And I think people should not get defrauded. I think people should pay their taxes, and I think people shouldn't give money to terrorists. So that's all very reasonable. And if you look at the way that the U.S. government in particular, I think, has handled crypto, I think they've been very nuanced and sophisticated in their handling of this. I've been very impressed. From everything from how to think about when to approve an ETF to public messaging around how to think about some of these things as potentially securities. But they've been very measured in the way that they've done this communication and how they've been thinking about it. And I think it's fundamentally because they realize that there's real innovation and real value here. And so as they're thinking about how to regulate this, I think they're realizing that if they're too heavy-handed, they'll actually kill off the innovation that's happening here, which is real. And there's real value in letting that continue. Of course, you don't want people to get frauded or avoid taxes, and so they'll have to correct those issues. And then from an arbitrage perspective, the challenge, I think, at this scale is if the government were to shut it off, there are other governments that might embrace it and might embrace it fully, such that that innovation then moves into those countries. And I think that would be a real loss for the U.S. if the government were to do that. And so I think actually in practice, what's going to happen is the government will clean up our understanding of where those lines are. And once we have that regulatory certainty, we'll actually create even more investment and more innovation, because then everybody will be on the same page about what the rules are. The real risk, in my opinion, therefore, is not that the government bans this stuff. I think the real risk actually is that nefarious governments fully embrace it. So if you think about, I generally trust the U.S. government, but if you look at other governments that you may not trust, this might be an amazing way to think about digitizing money and getting full visibility into every single transaction that's happening, because you can inspect the blockchain. And in those situations, I think if a government decided to fully embrace this, you're seeing really amazing things like social scoring on top of WeChat in China. I think if the government fully embraces that starts to be a very 1984 Orwellian situation where the government now has full visibility into every single transaction that every single person inside a country or potentially potentially even in a region, or if there's global adoption across the world, is doing, which I think is a pretty scary thought.
Absolutely. Starting from blockchain 101 for dummies here. Blockchain's always hailed as this holy grail of anonymity. How does that compare then to that radical transparency of being able to drill down into each individual transaction and in identity?
Yeah, so in practice, there are some chains that are more private. Even those are probabilistically private, but they're pretty secure. Products like Monero or Zcash are pretty secure. Coins like Bitcoin, let's say, are not. They're pseudonymous. Given enough data, let's say if you're an exchange that's done KYC, you can start to analyze the chain and see who's transacting with whom and how those money flows are going. And so in effect, you're transacting in public. And so in most cases, these chains are actually not as private as people think they are, which is why I think there's that risk, is that disconnect between how private or anonymous people think these things are versus how much they actually are, and potentially a nefarious actor's ability to sort of arbitrage that difference where people think that they have a lot of privacy and in fact they don't.
And obviously, one big commentator on the space, Fred Wilson, stated that regulators must be careful to do no harm in this regard. How else could regulators dent the market in a meaningful way, do you think?
So I worry a little bit less about dampening the market. I think the market is a side effect of real value being created. And so kind of the way I think about it first is where can we create real value and for people around the world, and then hopefully markets flow from that. And I think one of the big risks, aside from some of the regulatory uncertainty around how we should think about these as assets or as an asset class, is really around some of the trade-offs like we were just talking about around privacy. And I think there is real value to be had in some of these aspects and elements of privacy. For example, you probably don't want anybody to be able to see your salary. And if people are going to get paid on these platforms, then recurring payments from one party to another start to expose information. And so hopefully, I think we're able to get to a point where we are able to sort of express why some of these things matter. I'm reminded of if you rewind to kind of the mid-90s, there were these great debates in Congress around SSL and why SSL matters. One of the things that the Netscape team did really, really well, Mark Andreessen and co., was they made a very strong case that actually encryption is really important for things like e-commerce, because you don't want your credit card floating out there. And of course, that was a very, very important thing if we look back at all of the things that are now possible because we have SSL and HTTPS. And so, I think about long-term, I think a lot of the trade-offs that we need to make early on around things like privacy, we need to be very smart and have those conversations early and talk about the places where there's real value that's going to happen so that down the road, in 5 or 7 years, these markets can emerge.
Now, before we dive into the quick fire round, I do have to touch on the people behind the projects themselves. They're often suggested and noted as being decentralized teams. So setting you up incredibly nicely here, in a world where acceptance and adoption of these decentralized teams really is becoming mainstream, even with services providing them, how do you think about decentralized teams from an effectiveness and a meta perspective?
Yeah, I generally think decentralized teams won't work. I think in the very, very early days of any platform, they can work, and it's because there is not that much competition, and a lot of what you need to build out is infrastructure, and you have a small number of engineers that can communicate with each other to get those things done. Over time, what happens is you get more and more sophisticated operators, you have more and more complex projects that require more and more integration and communication, and so I think you see a re-centralization of teams, and so there's no substitute for 15 or 20 or 30 people physically being in the same space all the time. If I sort of play that forward a little bit even more, I think potentially the contrarian view here even more is that I think this will actually re-centralize back in Silicon Valley. And the reason is that at a certain scale, let's say going from 3 people to 25 people to 100 people to 500 people, once you start hitting real global scale on these things, how you go about building a company and how you go about building an organization, let's say organization because some of these things may not even be companies, how you think about building organizations that are effective and can scale and have global impact is tribal knowledge. And that tribal knowledge really sits in the heads of the people who have done it before. And the vast majority of those people are in Silicon Valley. And so I don't think it's an accident that if you look back at the last 30 years, with PCs, software, Internet 1.0, social, share economy, transportation as a service, and now self-driving, that all of those waves have their epicenter in Silicon Valley. Of course, there are some notable exceptions like Amazon, but by and large, that centralization has happened repeatedly in Silicon Valley. And I think it's because this tribal knowledge of how you build organizations that can scale is in the heads of a lot of people here. So what I would expect will happen is actually over time, crypto companies will actually re-centralize in large part to Silicon Valley.
But I do have to ask, in terms of practicalities, obviously a lot of the decentralization engineering-wise is due to cost and just an inability to scale at cost and numbers-wise. How do you think about the practical side of affordably scaling engineering teams and how that kind of looks in other markets?
Yeah, it's a great question. I think in general, the Bay Area is much more expensive than than most of the rest of the world, but your best engineers are order of magnitude more effective than your average engineer. And so a very small number of people who can start these things off and then build teams around them will still aggregate that value. And I think a lot of those engineers are still here. And so as long as you can get 5 to 10 of those really, really good people in one place, even if you have to pay them 25% or 50% more, let's say, often it's worth the cost. And so I think that pattern will play out until the cost of having those engineers is commensurate with the value that they create. And so if engineers in the Bay Area cost literally 5 to 10x more than they do in Berlin, let's say, I think you'll continue to see that happen. Hopefully it doesn't get to that point. Hopefully we're able to address some of these issues. But I think we actually have some runway to go. Put another way, I think there are these network effects in Silicon Valley that will keep people here and will make them significantly more effective. And network effects take a long, long time to degrade. I mean, you look at companies like eBay or PayPal, I mean, they actually just get stronger and stronger over time. It's pretty amazing to look at how network effects work. And there are real network effects in Silicon Valley that will keep pulling people in. That doesn't mean it lasts forever, but I think we're not anywhere close to actually this thing collapsing.
I mean, I'm having so much fun here. I'm gutted that I called it the 20-minute VC with episodes like this. Terrible name, clearly. But I do want to dive into the quickfire round. So as you know, I say a short statement and then you give me your immediate thoughts. How does that sound?
Sounds great.
Okay, so favorite book and why?
Ender's Game. Got me hooked on science fiction.
Love it. Tell me, networking, what are the tips and tricks?
Oh, no tricks. I think networking is really easy. Just figure out a way to create value for other people. If you find a way to help other people, then eventually it'll come back to you, especially in small communities like technology. So just go create value for other people is the best way to network.
Totally music to my ears there. What do you believe that most around you disbelieve?
In crypto.
Charlie Lee was on the show from Litecoin. He said that ICOs were his biggest concern for the world of crypto. Would you agree, and why on either side?
Sort of. I look at ICOs strictly defined as people raising large crowdfunding rounds from relatively technically unsophisticated investors as a symptom, which is that there are a lot of scammers who are taking advantage of this ecosystem. And I think those bad actors can be, if they're too large a part of the space, can actually gut the space from the inside. So I look at the ICOs as a symptom. But the underlying concern I have is the relative number of bad actors in the space who could give it a bad name or poison the well.
When will institutional capital enter the space in a really meaningful way?
That's a great question. I think it's really hard to say. If I had to guess, I think a lot of the institutions are looking at it right now and are interested in it. And there are a lot of signals that are causing them to have to pay attention. I think notably that this last market correction didn't take the market to zero, and so it's been around. The fact that it keeps surviving, I think, makes them pay attention. But I think when they decide to move in any meaningful way, and for what definition of meaningful, I think is anybody's guess right now.
Now, this isn't in the schedule, but I have to use the show for some means of my own. Scaling knowledge from kind of 0 to 1 in blockchain, what would your advice be? Could be blogs, could be books, could be newsletters, could be white papers. What would your advice be just in gaining that foundational knowledge?
It's actually, a lot of it is online now, which is pretty great. And so there are some seminal things to read, like the Bitcoin white paper, the Ethereum white paper. There are a number of blogs that are well shared and archived, and I can share this with you if you want to post them up. And then a lot of it is happening on Twitter and Reddit and in Telegram groups. And so it's actually just through immersion. So following the right people, being in the right Reddit groups, but it's all public. And so that's what's great. It's actually very accessible. It takes a little bit of effort to go get plugged into those, but if you generally just follow the people that high quality people are following on Twitter, you can get there.
Love it. And we will share those on the site. And then the final one, I'm devastated to say we're going to have to do a round 2 soon, but I would love to finish on the most recent publicly announced investment and why you got so excited.
Yeah, we did an investment in a company called Coda that has some novel ways to compress the blockchain itself using zero-knowledge proofs. And the reason I think this is really interesting is what it allows is for a much, much smaller blockchain, which allows for much more decentralization. That decentralization enables censorship resistance and seizure resistance. And so it makes the currency itself much, much more scalable and much more useful. And so that as a core principle around which to build a company, I think makes a lot of sense.
Obviously, I've so enjoyed the show today, Avichal, so thank you so much for joining me, and I think I clearly owe many a mojito to Elab for making the introduction.
My pleasure. Thank you.
What did I tell you? A very special episode and a very special individual, and I couldn't be more excited for the future ahead with Electric. And if you'd like to see more from Avichal, which you must, and you can follow him on Twitter at Avichal. Likewise, we'd love to see you behind the scenes here at the 20-Minute VC. You can find us on Instagram at hstebbings1996 with 2 Bs. It'd be great to see you there. But before we leave you today, are you told your standards are too high? Well, the League is the app that tells you to keep them that way. They know your time is valuable, so simply tell them your preferences, and they will handle the scouting scouting and vetting for you. Plus, even better, your profile will only be seen by people who match your preferences. Matches expire after 21 days, and so there are no drawn-out games. And they even require LinkedIn to protect your privacy and block you from matching with co-workers and business connections. I have to say, I am a big fan, and you can apply now by downloading The League on the App Store or heading to theleague.com. And speaking of products that I'm a fan of, you must check out Zoom, the fastest growing video and web conferencing service, providing one consistent enterprise experience that allows you to engage in a variety of activities, including video meetings and webinars, collaboration-enabled conference rooms, and persistent chat all in one platform. Plus, it's the easiest solution to manage, scale, and use, and has the most straightforward, affordable pricing. But you don't have to take my word for it. Zoom is the top-rated conferencing app across various user review sites, including G2 Crowd and TrustRadius, and you can see for yourself. Sign up for a free account, not a trial. Just visit zoom.us. And speaking of connecting people there, you must check out Culture Amp, the platform that makes it easy to collect, understand, and act on employee feedback. From onboarding surveys to company-wide engagement, individual effectiveness, and more, the platform manages multiple sources of feedback and connects the dots for you. And that's why companies like Slack, Nike, Oracle, and Lyft all trust Culture Amp, and it enables leaders to make better decisions, demonstrate impact, and turn your company culture into a competitive edge. So put your people and culture first and find out more now on cultureamp.com. As always, I so appreciate all your support, and I cannot wait to bring you a very brilliant Founders Friday with Heather Fernandez, founder and CEO at Solve Health.